Thanks for staying with us. Tom, you were talking about, what is crypto, some of these exchanges. We're all familiar with the Sam Bankman-Fried and the spectacular collapse of FTX. But there are others more prevalent. And one of the ones we were talking about is Coinbase. Tell me what's going on with Coinbase.
Well, it's timely. Yesterday, the SEC issued what's called a Wells notice to Coinbase. And a Wells notice is essentially a warning to the company that the Securities and Exchange Commission has found that based on the evidence they have to date, the company receiving that letter is violating the federal securities laws. And a notice is deemed by the commission to be a fair way of putting the company on notice and giving them an opportunity to come into the commission, meet with them and say, we think you're wrong. So potentially Coinbase, who has received this Wells notice, could go to the SEC and convince the SEC that they're wrong. That won't happen. There will be proceedings that will be filed.
Your take on crypto is very different from what I've read, which is you're saying they're operating like a security. Are they a security?
Well, two different things. Coinbase as an entity is not a security. Coinbase as an entity is a securities broker-dealer operating as an exchange.
So they're buying, like a Merrill Lynch buys and sells.
Without bothering to get this little thing called a license. We all know the rules of the road. We know we have to have a driver's license to get in a car. We have to have a certain age. We have to be tested. And any license is accompanied by some obligations. There's something called the good deal exemption in state and federal securities laws. It's not really a thing, but people think, as long as I can do it and get away with it, why not? It's a lot cheaper. It gets me ahead of my ahead of my competition. Yeah, Coinbase in particular has been shouting very publicly for a long time that we went to the SEC. We wanted them to tell us how to do our job. We wanted them to tell us how to comply with the law. That's not how it works. We have to determine when we're driving the car down the highway how to responsibly operate that vehicle. What's the speed limit? What are the weather conditions? How many cars are around us? I can't call the Division of Motor Vehicles and say, hey, how do I drive today? That's exactly what they've been doing with the SEC for years, and it's coming to a head.
They got this tacit license to operate, kind of like if I open up an LLC, it's just filing paperwork, but they're not properly regulated. But it seems like a failure of oversight by the SEC for the last decade. A decade plus, or is it you operate and then when you make a mistake, kind of like OSHA, if you have an injury on the job, then they come in and go, whoa, you were violating these rules. It's your obligation, I get it, it's your obligation to know what the rules are, it's your obligation to know what the law is and operate within that.
That's right.
And as long as things are fine, no one's going to bother you, but things are no longer fine.
That's right. So there are gray areas when defining a security. And this is what these firms have tried to do, is to sort of weave in between the black and white and land on something that's arguably not a security. But I'll give you one of the most famous cases in securities laws, and it's now 80 years old, is a case involving a company called Howey. And Howey creates this test for an investment contract. And it's really interesting because in the Howey case, which is Howey in the Hills, Florida, by the way, but it went to the U.S. Supreme Court, it involved oranges. Pretty important crop in the state of Florida. So what do you think of an orange?
80 years ago.
Is an orange a security?
No, I don't think so.
Okay, so an orange is not a security by itself. What about an orange grove? If it's yours, you plant the seed, you're doing the work, that's not a security. But what if it's mine? I say, look, Steve, I'm going to go plant oranges. I'm going to raise these, I'm going to grow these crops.
So I'm betting on you.
I'm going to sell these crops. I'm going to make a bunch of money. Would you give me $100,000 to put in my venture? That's a security. Okay. And that's what the court said in 1942 or something like that. So it's the same thing with crypto.
You were just a young lawyer back then.
Thank you very much. The thing about crypto is every single token, every single coin, every single aspect of the blockchain is dependent on the efforts of others. You and I could not go buy or speculate in any kind of a cryptocurrency without knowing that there's somebody mining the currency in order to create the currency and the product, or through proof of stake is another alternative way of authenticating ownership in this silly thing we call cryptocurrencies. And it creates additional lending programs with these cryptocurrency exchanges. Earn is the name of one that Coinbase has been offering, and that's specifically mentioned in the Wells notice, and it will be found to be a security.
So Tom, here's what
no question about it.
Every banker I've ever met, and I love this about every banker I've ever met, they're very conservative people. Blue suits, conservative cars. They are not what you'd call entrepreneurial chance takers. They understand the pyramid process, build, stable. Yet we have several banks that have gone under, that one of them, I think was Signature, like 100% of its investments was in crypto. The big SVB, which kind of started the collapse, you and I talked about this, we were like, well, I don't think they had much crypto. When you get underneath, either they had about a 10% market share in crypto, A, B, they had invested in a lot of companies that were crypto-based companies, so it was like another derivative level up. How did this happen?
Well, it's funny you mentioned the blue suits, because there's an article today in the Financial Times about crypto and how the men in the blue suits, and women, but the article said mostly men in the blue suits, are legitimizing or attempting to legitimize crypto, like the bankers. So in the case of Silvergate Bank, their depositors were almost entirely crypto-related depositors, including FTX. So their business model was blown up with FTX and with a corresponding collapse in other cryptocurrencies. Signature Bank had maybe 20% of their deposits related to crypto. The thing that's interesting about the recent bank failures, and maybe encouraging, is when I was the commissioner at the Office of Financial Regulation, every Friday afternoon I was signing orders closing banks. The reason we were closing banks is because of poor assets, bad decisions by management, or just luck.
How long were you there?
A year.
So you closed 50 banks?
Oh, gosh, probably more.
Really?
Probably more. In 2011, 2012.
It was a great time to be in the banking business.
It was a great time to start a new bank with a beautiful, pristine de novo balance sheet. But if you were an existing bank and you had a balance sheet, you were wrestling alligators.
Especially if you had all these mortgages upon mortgages upon.
But the point is, the banks made mistakes or were unlucky in what they held on their balance sheet. The assets were bad. That's not the case of these banks. Silicon Valley Bank had a great asset book. It had a great portfolio of venture capital companies, most people would say. They failed the old-fashioned way. They just forgot that there's interest rate risk in long-term treasury bonds. You know, everybody's going to say, well, if it's issued by the U.S. government, then it's money good, right? And it is. But you and I were talking 10 minutes ago about inflation. So if you bought a 2% yielding 30-year bond a year ago, and it's going to be paid back over 30 years, the value today is now 40% less. That's a real hit to your balance sheet. And these banks don't have to mark to market. In other words, they don't have to tell you and me as investors, except in a buried footnote if you really search for it, how much of a liability they have or how much of a hit they would take if they sold their existing portfolio, because they can hide it by saying, these aren't really held for sale.
Was FTX the canary in the coal mine?
No. FTX is really very different from Silicon Valley Bank. As an example, Silicon Valley Bank, again, they did not blow up because they had crypto problems. They
fail, and then all of a sudden, these cryptos underneath it started to fail, and then the bank started to fail as well. That's why I'm looking at it. Am I wrong?
You're right chronologically, but FTX was not the trigger, was not the canary for Silicon Valley Bank. FTX was not the trigger for Signature. They had their own problems. You know, Barney Frank of Dodd-Frank was on the board at Signature Bank.
Oh, interesting.
The author of Dodd-Frank, the law that would cure bank failures for all times, sat on the board of Signature Bank.
Oh my gosh. All right, here's what we're going to do. When we come back, I want to ask you a critical question. If I lost money in crypto, what can I do about it? Stay with us when we come back. Thank you for staying with us on this fire hose of information related to banking and crypto. So, Tom, in our final segment, former chief banking regulator, commissioner on a number of things, former state house member, securities lawyer, you have a new gig. Tell us a little bit about your new gig. It's kind of interesting.
Well, as I mentioned, Coinbase and other crypto exchange operators for years have been saying, tell us what to do, but the obligation is on them to know what to do. They've been lobbying for new regulation, and some others, including some people in the Congress and in the Senate, think, maybe we need some new legislation, some new stuff. It's not. It's no different than taking an orange and turning it into a security by creating an investment out of an orange. An orange can be a commodity, it can be a fruit, it can be a security. The laws that we have in the state of Florida are very good, and they protect investors. And they're designed to protect investors. And they protect investors when they make investments in, quote, investments or, quote, securities. So even if cryptocurrency exchange operators are right and they say it's not a security, there is no way they will ever win on an argument that they are not investments, because everything they do says crypto as investment. Everything they do looks like a securities broker-dealer.
So I know you can sue if you lost money, but if I invest in, I go to the stock market and I lose money, or I go to Las Vegas and lose money, I can't sue the slot machine maker. Am I allowed to, if I invested in Coinbase or these others and I lost my shirt, and for a lot of people a lot more than that, is there a legal remedy for that?
There is a legal remedy, and it's the same legal remedy that you would have for any securities transaction. Securities, as we said earlier, they are required to be registered in order to be sold. The people who sell them are required to be registered. Coinbase and other exchange operators are not registered, and the crypto, again, currencies, I don't like the word, are not registered as securities, and they should be. As a result, if you have invested in a cryptocurrency through a crypto exchange and using a crypto wallet, you do have legal rights under the Florida Securities and Investor Protection Act. And I've watched this unfold over the last year or so, and I couldn't stand it anymore. So last year, I partnered with Guy Burns, an attorney in Tampa, an outstanding securities litigator, and we formed something called Crypto Lawyers, because we think it's important to enforce the existing laws, and it's important to give remedies to people who have lost money who may have no idea that there's recourse available to them.
Thank you. That succinct, excellent. Hope you enjoyed it as much as I did. We'll see you next week.